do your research, understand your market and the competition first before you even spend money on patents, because you can get a patent, but there'll be other stuff there that'll be competing out. So really it is, do your research first before you do it.
Most founders believe if they have a patent, they've created value. But what if I told you that some patented innovations are effectively worth zero? Today, we're going to unpack the brutal reality behind intellectual property valuation, why future income matters more than ideas, why disruption can destroy value overnight, and the hidden ownership mistakes that can completely kill investment deals, acquisitions, and commercialization opportunities. And later in this episode, our guest, Leon Stephan from Advivo Business Advisors and Accountants, is going to explain why some businesses think they own IP until due diligence proves they don't. If you're a founder, innovator, startup, or investor, this episode could save you years of pain. And don't forget to subscribe to the channel so that you can learn valuable lessons from experts like Leon. For our viewers, I'd like to introduce Leon Stephan, who has spent decades in banking, corporate finance, funds management, and small to medium enterprise advisory. He's worked across valuation, capital structuring, risk analysis, and commercial strategy. And today, we're diving into one of the most misunderstood topics in innovation, intellectual property valuation. Leon, welcome to the podcast.
Hi, Trevor. Thanks for having me along.
It's a real pleasure, and looking forward to what we can learn from you for all our viewers. So, Leon, when founders hear the phrase IP valuation, many immediately think of patents equal value. But from a commercial finance perspective, can you explain to our viewers what is intellectual property and what actually creates value?
Really good question, Trevor. And you immediately a lot of people, the brain jumps to patents when we talk intellectual property. But intellectual property is far, far more than that. And the definition from a valuation point of view is value of a commercial asset is its ability to generate income into the future. So I have seen too many times in the past where people come to me and they've got patents or other forms of intellectual property, which we'll talk about, and they think it's worth a fortune. But unless it can be commercialized and generate income, or other people will perceive that it can be, and they can prove that up through due diligence, etc., it might well be valueless. I've seen so many instances, one recently in the energy sector where it would cost so much to commercialize it, and it was unproven. It's unproven. It's just a bit of paper. That's all it is, really. It's a thought. It's a thought bubble someone's got. But unless you can prove it's going to generate income, why is someone going to pay for it? Why are they going to invest in a patent? Is an investment. Think of it like a term deposit. You put your money in, you want a return on investment. So the ability to generate income into the future implied with an appropriate return on investment at the back of it.
Okay. So you've said that the accepted definition of commercial asset is the ability to generate income into the future. Why is that such an important starting point? And why should startups and people in the innovation space actually value their IP?
Well, there's so many reasons for valuing IP, and you did ask a question in two parts, which is there are many other forms of assets other than patents, so we just don't go down that path at the beginning. But the money that people have invested in themselves is really important that they're getting a return on. So that's number one. Yeah. But quite often the commercialization process, as you so well know, involves the introduction of other capital from banks or other investors, or you might need to restructure it for some sort of legal purposes. At the end of the day, we all have some reason we need to pass it on and sell it. And any commercial asset might need to be passed on through estates or whatever. It's got to have a valuation applied to it at some time for some reason or other. And the better we we can identify it, prove ownership, and show that it can generate income, that's
Hmm.
what will there, because why else does it have a value if it doesn't generate income?
Yeah, great point. So I guess, understanding that it's actually really important for startups to understand what leads to that value. What challenges do startups face when they try to prove future income without any sort of historical trading performance?
Yeah, really good point, Trevor, because it obviously it's a lot more challenging for a startup than it is, you know, a Coca-Cola with something
Yeah.
that's been out in the marketplace for ages that's generating income. So with a startup, a lot of people fail to think, okay, we're talking about future income. So what understanding the industry, the market, their ability to commercialize that, their team and the resources they've got. Do they have the
Mhm.
resources? A clear understanding of the cost going forward, to show that they can do it, because I'm an ex-venture capitalist as well. A lot of a large portion of venture capitalist deals fail because they run out of capital along the path. So
Yeah.
clearly documenting every line by line, of a forecast of what's going to be there and having backup data to it to say it valid. That it's, you've got to think about this, that it's not just for yourself, that it's like going through your own due diligence. Will this stack up?
Yeah.
Am I going to put more of my money in it, or am I going to ask my, as many people do, friends and family to put more money in it, or am I just throwing good money after bad, which happens too often?
Yeah. Yeah. So, you know, accepting that it can be difficult to predict that future lifespan, but what happens when, disruption can completely change a market?
Oh, look, at many years ago, and this was an intellectual property valuation, but it's a classic example of disruption. And I know that's something dear to your heart.
Mm.
But I valued a business for someone to buy, which was a video hire business. And back many years ago, they were very successful businesses.
Yes.
Um, and you think of just the trail along that alone. It went through a couple of changes. It went through from VHS and beta tapes, which had problems with quality and failures and everything like that. So technology got upgraded to DVD, so that was a new thing, but an increased cost of changing from one to
One to
another,
the other.
big
Yes.
capital costs that wouldn't have been allowed for in those original forecasts. And then along came the Netflix model of streaming. And how many video stores are out there now?
One.
I I rest my case.
Yeah, awesome. So I guess this is where I find, really fascinating because product market fit and disruption strategy can completely change valuation assumptions. So I guess, Leon, yeah, you mentioned the VHS and video rental example. At one point, that business looked incredibly valuable until technology changed it. So, as an example from that perspective, how do startups actually defend this?
Oh, look, it comes back to what you said to a large point there, market fit, understanding the industry. So when I do evaluation, it's probably important to understand that there are really, for an external valuation that's going to be relied on by other people, there are definitely three components to evaluation. The
Hmm.
first one is a market analysis. What is the industry? What's the market? What's the technology? What's the legislation? Um, what's the risks that are going forward on it? Disruption, etc. Look what we're seeing with AI at the moment, how quickly
Yeah,
that's moving, for example. So
good
the
example.
changes that happen, they've got a market analysis, then you have a valuation report, which goes through all the risk analysis and adopts of that. And then the part that people want to talk about is the actual numbers that come out of the end. But unless you've got those first two components and done the risk analysis and understood the market and all of those forces could that that are, may, or could influence it and take those into account, you can't get to the numbers. So it's a fairly involved process, and it often involves input from other parties like yourselves to provide that market analysis, particularly understanding the competition.
Yeah.
I've I've said to you before, when I had venture capital funds, the amount of times we were approached with products and, uh, in the early days, the internet was not advanced. You couldn't access information like you could now.
Yeah.
There, you never knew what the competition was. So you could have someone in Australia talking about, they've made the best mousetrap. There could be 3 million of them overseas you didn't even know about. And as globalization comes on, it becomes, the more and more globalized we are, the bigger that risk is. Yeah.
Hey, absolutely, absolutely. And we see it time and time again that, organizations based here, we do the analysis, we actually find many, many companies. Now, for the startups that are listening, that doesn't necessarily mean you're over in debt. It just means that this is where disruption strategy can play a really big part in finding those niche markets. So, Leon, what do you see as the biggest mistakes founders make when they believe they've invented the best mousetrap in the world?
Without a doubt, most people have this blind faith in what they've put all their time and effort into is you know a superior product without doubt. But there's two parts to it, I think, Trevor. One is that it has to be commercially viable as well too. So
Mhm.
yeah, the old saying of the better mousetrap's been around for years, but there is actually a story. I can't get all the details right at the moment. It's been around for so many years, but you know, let's say someone invented a mousetrap that was electronic and it was, it cost $100 for a mousetrap, but
Yeah.
one mousetrap, $100, you could have bought 40 mousetraps for $100 that were nowhere near as good technically, but
Yes.
would 40 mousetraps have done a better job, or would 20 and half the
Yeah.
price? So it's got to be commercially viable and economic to do it, and be able to produce right. So a lot of people don't put enough effort into understanding the market, their cost competition, and being really across the what their production costs are going to be to go to
Mm.
the market, to be competitive. They're thinking of the outcome, not the journey to get there a lot of the time along the commercialization process.
There's some really wonderful advice points there, Leon, for people to take on board. And I guess for our viewers, make sure you stick around because in a moment, I'm going to get Leon to explain why some businesses can spend years building valuable intellectual property only to discover during due diligence that they don't legally own it. So we'll come to that shortly. The next thing I think we want to start to explore, Leon, is what really counts as IP? We've talked about patents and so on, but from your perspective, what really counts? And when people hear intellectual property, they often think just of patents and trademarks, but in reality, IP can be much broader than that, can't it?
Oh, definitely, Trevor, without a doubt. And you know, I do valuations of enterprise valuations and other all sorts of other valuations, not just IP valuations. But I'll give a good example of something else. So a merger acquisition that's going on at the moment for a client,
Hmm.
his intellectual property is actually his client list. He's been an industry takeover that's going on, and they want to get more market penetration, and they
Hmm.
do that by acquiring his business. It's his contacts, his clients, and some of his other suppliers he's got. That's his intellectual property. It's not a patent.
Yep.
So quite often, and it's very careful not to fall into think of it's any one thing. Quite often, it's a combination. Um, I will throw a note in here, which quite often with smaller businesses, that the founder has what's called personal goodwill. They've been the runner
Yep.
of the business for many years. It's their contacts, both on a supply and sales point of view, and everything like that. In effect, that one person quite often is the business, their personal goodwill. So a big part of creating value in businesses and creating your intellectual property. One business I did this in the food production business, is making sure you've got everything documented. Yeah, your processes, your systems, your risk management, everything to think that becomes intellectual property. And so quite often it's a combination of many um, things that might form intellectual property. And in some technologies, people don't even do patents because patents can give away too much. They have
Yeah.
black box technology where they fill up with all other stuff that no one can scan it and see what it is.
Yep.
Um, it's secrets. Kentucky Fried Chicken and their secret
Yes.
herbs and spices, Coca-Cola and their recipe, the bottle shape, colors. There's so many things that form intellectual property. It's any one thing that will influence someone else to either buy your product or buy the business.
Yes.
And quite often it's a combination of all of those things.
Yeah, that's great. I guess what I'm seeing there, Leon, is yes, there's patents and trademarks and all that legal stuff, but you're also talking about the commercial elements of how that business actually generates its revenue and generates profits.
Well, and quite often it's the team that you put around it as well too. So
Mhm.
because you can't commercialize unless you've got the skills and resources to do it. So,
Yeah.
but yeah, the best thing that I could give as a hint for a lot of people is document, 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 document,
Yep.
and make sure you've got everything systemized, processed, and everything like that. So someone else can pick it up and run with it afterwards. Because if you don't have that, you may not have anything to sell. Even if you think of a patent gives a conceptualization and some of the detail, but it doesn't tell you how you build it and all of those other things and like that. So there's a lot more that goes behind it than
Mm.
just having a patent. Yeah.
Yeah. Brilliant. Okay. This next part is really critical because I think many startups unknowingly expose themselves here. You've said that one of the biggest inhibitors to IP value isn't the innovation itself, it's ownership problems. Can you explain that, Leon?
Trevor, I've been involved in many due diligences on businesses and intellectual property. And what we've talked about already, we've talked about a number of different processes that are involved, and a lot of those involved other people. You've got employees, you've got contractors quite often doing some of the production and building on whatever your magic mousetrap is that you've got, the widget that you make that you've got your patents on or whatever. Um, all of these, anyone that touches something along the way needs to have signed for a start a confidentiality agreement, assignment of the intellectual property to the appropriate entity. The entity should be at least a company or a group of companies that's usually involved, but you have a company, not to an individual person, because then if something happens to that person, it's problematic. So getting everything owned and assigned that anyone that touches it or comes in contact with it has no right to it, no um, no claim on it,
Right.
um, no uh, no risk at all. That when someone comes to look at this later on, they say, "Well, hang on, didn't this guy over here really develop this part of it?" And if you don't have any agreement that says it's all assigned across to, let's call it your company for sake of easiness, then you could have nothing. If I can give you a little case study, client of our firm, I won't mention any names, but they were thinking about ex- expanding their international distribution and bringing in a partner overseas.
Mhm.
And that partner was going to wanted an equity stake for that involvement as well. And they said, well, okay, we need to look at this. And we looked at the structure and I said, well, hang on, we've got a few problems here because for a start, like a lot of the businesses, there was a group of companies involved in that, and different parts of the business had done different parts of it along the way. So theoretically, in reality, legally,
Yeah.
different parts of the intellectual property were owned by different companies, all under the one group, but different parts. But that's not
Yeah,
how you
gotcha.
bring someone in. There was other contractors. There was a former partner in the business earlier in the piece, and we had to restructure it and get it all together. Now, this is a good reason to ask, why would we do a valuation as well? So for the restructure, you need a valuation for stamp duty purposes.
Yes.
Fortunately, in this case, that worked out really good because it was, for want of a better word, such a mess. The valuation was very low because it was a disaster,
Right.
basically.
Right.
So did a valuation, which was low, and an action plan of how we need to fix everything up, which took about 12 months to do.
Mm.
So, and when I did that, I said, look, if it was all sorted out without doing the full valuation, it's probably worth about bit more than, say a bit more than 10 million. And it was only sort of in around the one-ish at that stage,
Right.
worth about 10 million. So did all that. Unfortunately for him, he went through a divorce, not long after it was all
That
tidied up,
happened.
but it did prove up that it was worth over 10 million. It was worth 12 at that stage. So that was
Mm-hmm.
another independent valuation. He kept the business, and a couple of years after that, again, he sold the business outright for $23 million. Now, if he wouldn't have done all that tidy up back before, the valuation was, and he would not have sold it. As simple
Yeah.
as that.
Yeah.
So
Yeah.
it shows how all that documentation of that, even the biggest trap I see a lot of the time is even the directors need to have signed across the intellectual property to the company. They quite often will have family members in the business say, oh, they don't need to sign anything. So it's everyone that touches on the way has got to have signed these documents and signed all the IP across to the appropriate entity.
That's a fantastic example because I mean, even for the startups that might be watching this, Leon, just really reinforces, the message that making sure they're ticking all these boxes along the way. So learning from you here today is really valuable. Yeah,
Sorry, Trevor, can I just add one thing? And please learn from that. Do it now, because it's very hard to do it later on. And some of those people later on, when they know that you're looking to make some big money at the time, they're going to put their hand out and want some money to sign the documents to assign it over a later time. So if you
yeah,
do it right at the beginning, as you should, will save yourself a hell of a lot of time and money, and maybe not lose that big deal that you're hoping to
absolutely.
catch one day.
Absolutely. Good, good, good. Can you explain what an IP audit actually is?
Yeah, it's bloody involved. But really it is going back from day dot, from when someone's had this conceptual idea. I've seen it from the simple story of two mates sitting around having a beer and talking about something, starting something out. But you know, does that give rise to that person having a claim on the IP?
Yeah,
Um, if they're not involved all the way. So it's going right back through history and working through all the different employees, stakeholders in the business,
contractors,
contractors, service people, everyone that's touched this in some way, shape, or form, and looking at what legal agreements are in place with that person, looking at sometimes who they've else might have been in contact with about distribution rights or other things like that. What else has been exchanged in correspondence with those? Any other sort of commercial agreements. It is a very arduous, well, depending on the amount of time involved, obviously, more time, the more involved. But obviously, the number of people and the time involved, and just going through every person that's been in contact with it as best we can
yeah,
track
yeah,
down through history. So again, it comes back to, like I said before, document. It's record keeping of all these things. Good record keeping is imperative to improving the value of your intellectual property.
great. Thanks for clarifying that, Leon. I guess just a real quick one. Out of every 10 valuations that you do, how common is non-compliance?
More than 80%.
Really? Yeah, yeah. So it's a good lesson for people to really take heed of this advice that you're getting today and start right from the beginning and making sure that you're documenting and making sure you're protecting your claim on the intellectual property. You've said you've seen situations where the valuation effectively becomes, not worth much at all. Is it going back to those things we've discussed, or is there something else to add
Oh,
to
look,
that?
it's a lack of records is certainly doesn't help. So if people don't have records, but usually, the working example I used before, we could fix everything over time. It needed time and everything to do it. So and people were cooperative. But I have seen one where it was a little bit more complex, that one of the parties who realistically had a claim, in my view, had recently died, and there was a rather messy estate issue going on at the moment, and the family were trying to claim that they thought they had a claim on it as well. And that's much
Yeah,
harder when you've got someone who's deceased as well, who was probably
Yeah.
going to be more cooperative.
Yeah.
So it does to, yeah, there's so many circumstances that could come into play that just means do it right in the first place, and don't go down this path. Make sure you start with those agreements. Everyone
Yeah.
touches it first. Yeah,
And just being really diligent about it, to ensure that they don't end up in those sort of situations.
much better to be right first than try and fix something later on.
Yeah, absolutely. So could you quickly just go through what a valuation process actually looks like, Leo?
So one of the first things we do is send out a information checklist requirement. It's a a full page of information requirement. There's usually more after that. So gathering that information up is part of it. Understanding what the valuation's for, because if it's an internal valuation as opposed to required for capital raise or something like that, it's going to be more complex. Um, and as I said, if it's say capital raising or something like that, it might need like your Galaxy reports to understand the market, the competition,
Hmm.
everything like that. Because I can't do without me understanding all that information, I can't complete a valuation. So,
Yeah.
um, let's say you either need market analysis or you don't, depending on the circumstances. You need you really need to. I'm pretty fortunate. I've worked in a lot of industries over too many years, so I have a good understanding of a lot of businesses. But you need to understand the industry. So then, regardless of whatever else you've got to understand the industry and do some research. You've got to get to know the people. You've got to have a look and see what their systems and processes are. You've got to understand what they do have documented and that someone else could pick up. But it's only good if someone else can pick up and run with it. It's no good if it's just only applicable from this is how we do things around here. Doesn't work. Yeah, so it's generally involves certainly business visitations and understanding how it works and who the people are and their skills. And then going back through the patents, I have seen, looked at valuations where what they've got now is not what the patent said as well. So you've actually got
Really?
to go right through the patent because, like everything, things
It's done.
evolve over time, and improvements are done. Improvements are good for patents, but people quite often say, "Oh, well, we've got this now and we won't spend the money," but they really should be going back and doing an update on the patent if they're doing updates, to the system, which protects their patent integrity a lot more in doing so, but and makes it more valuable. Otherwise, it leaves it open to someone else coming in on their improvements if they're not covered in their patent. So patent compliance is really important. Then it's going through and then looking at the risk analysis on that, and then we have a fairly involved process of so everything we do in valuations is taking it on what's called discounted cash flow methodology. So you're
Yeah.
looking forward, you're preparing a 5-year cash flow forecast. Well, depending on the so if you had a 20-year patent for argument's sake and you're at year 18, you've probably only got 2 years, you've got a terminal
Yes.
life. But if something's got what should be perpetuity or going beyond, you'll have 5 years plus perpetuity.
Yeah.
Modeling goes onto that using perpetuity factors. So building up that cash flow and going through interrogating all of the assumptions and being able to document and justifying them. And, so uh, particularly like if you go back to your question on the startup, if it's a startup, needless to say, they're probably going to have to spend a bucket load of money on some sort of market at the beginning. So, and they'll say, oh, 100,000 or whatever, just fucking up. No, I want a quote from someone who's going to do the marketing and do all that
Yeah.
and go through that. So everything I can say, that expense line that relates to that document over there, sort of thing. So proving it
Yeah.
up. And if people often go out to market with um, looking for investors or in some way, shape, or form without all the facts. If you don't have those facts that you can justify after 2 or 3 failures, being able to evidence the facts are solidly based and robust, people will lose interest and they'll go look at something else. So important
Yeah.
to make sure you've got
Excellent.
everything is fact-based. And
Yeah.
then building that model out, then applying working out an appropriate discount rate for the industry market, the product, and what you believe that the changes might be in the future is the next step. And then you're taking the report, doing the valuation, modeling, and from the financial model, and put it all together. And you've
Terrific.
got about a 40-page document.
Wow. So, it's for people to understand, it really is an in-depth process and taking it from there.
If I can say, if I could just add something, so think of it like going to a bank. Yeah, what are they going to do to accrue a lot of
A
money
loan.
for you? It's the
Mm,
same thing. We're giving effectively an evaluation with a recommendation to someone to invest or something like that. This is
yeah,
what's worth to pay. So it's similar to a process a bank's going to go through to approve someone for a multi-million-dollar business loan.
excellent. Great advice. So we're starting to run out of time, Leon, but if you could give founders, one piece of advice before they spend, so much time and energy commercializing their innovation, what would it be?
Trevor, you're going to love this one. Do your research, understand your market and the competition first before you even spend money on patents, because you can get a patent, but there'll be other stuff there that'll be competing out. So really, it is do your research first before you
Hmm.
do it. Work out your concept, but in part of that, you've got to have some rough ideas on the commerciality of what you're looking at. So
Yeah.
if you're thinking you've got the best mousetrap, well, how much is it going to cost me roughly to build? And they can be back of envelope numbers but they've got to be reasonable to say, does this stack up in the marketplace? That's does it
Nice.
does it pass the smell test? Yeah.
Yes. Yeah. No, very good. So I just want to mention at this point for our viewers, Leon has prepared a downloadable resource for this episode that helps founders understand the key elements required to protect and maximize the commercial value of intellectual property. Contains all the information that you will need to tick off before you seek a valuation. A brilliant insight to know in advance and therefore prepare from day one in accumulating this information. You'll be able to find the download link just below in the description. So, Leon, this episode highlights something every founder and innovator needs to understand. Ideas alone do not create value. Commercial value comes from solving meaningful market problems, generating future income, understanding disruption risk, and ensuring your ownership structures are absolutely watertight. Huge thanks to you, Leon, for joining us today and sharing decades of real world corporate finance and valuation insights. Thanks for coming on to the show, Leon.
Been a pleasure being here. And look, I really hope it's of value to your listeners and that they take heed of some of the advice and put it to use to increase their value.
Fantastic. I hope they do too, Leon, because we see far too many that have made those mistakes and then have to backtrack and spend lots of money and time and energy trying to fix it. So, viewers, if you found value in this episode, make sure you subscribe to That Product Market Fit Guy. Share this with another founder or innovator and check out the downloadable resource link below. And give us a like. It's so important for the YouTube sharing of this content and getting it out to other innovators. Thanks for watching this one. We truly hope that you got some fantastic advice out of this, and we'll see you in the next episode. Ciao for now.
Thanks, Trevor. All the best.